Hey everyone, welcome to the Go Big Live Real Estate Investors Podcast. I'm your host, Matt Drouin. I have an awesome guest on today. Same is Mr. Brock Mogensen. Is that right, Brock?
Said it right. Most people don't get it right. So you got it right first tee. There you go.
So not only is he a seasoned investor and principal at Smart Asset Capital, he developed his own advanced model for analyzing deals called the Real Estate Syndication Analyzer. Brock's focus is on finding deals, underwriting, and asset management, and he currently manages over 25 million in assets across various real estate sectors. Host of the largest monthly multifamily meetup in Wisconsin, Brock knows the ins and outs of the industry and is excited to share his insights with you on our show, the Go Big Live podcast. Welcome to the show, Brock. Nice to have you.
Thanks for having me on, Matt.
Yeah, so I kind of like to start off the show with a little bit of background. You were born and now you're here. What happened in between? Cliff Notes version, of course.
Cliff Notes. Yep. So I grew up in the Wisconsin area, and grew up in this area. And really, throughout my years growing up, both my parents worked, very blue collar jobs. My dad drove a truck. My mom was a teacher, but my dad bought 2 duplexes when he was in his 30s or so. So growing up, I saw what simply having 4 units could do for your lifestyle, right? If you have that extra income coming in, what that could do to enhance your lifestyle. So that always was kind of cemented in my brain growing up. Fast forward, I go out to college, out to Utah, come back, take a job, working in a call center, not making much money, right? But I had the goal of I'm going to buy a duplex, right? It was just kind of cemented in my mind. I need to buy a duplex. So I'm living at home, saving up some money, buy a duplex a year or two later, did the house hack model, loved it, right? The first month, living for free. I had roommates and a tenant living for free. I think I made $500 in my first month in cash flow. And I'm like, shit, this is the business. This is what I need to go all in on. How can I do it? Right. So, didn't have a ton of money, right? I wasn't making a 6-figure job where I could, stash capital and really buy a lot of properties each year. So I had to get creative, right? So I went down the path of wholesaling, flipping, right? A lot of paths people try to figure out in the beginning. Just didn't really have much luck or desire, I guess, to really go all into that space. But then came into this concept of syndication and found out about what that was, right? Leveraging other people's money to be able to go out and buy these large properties. That was like, okay, this is how I'm going to do it. This is how I'm going to go big. Spent some time learning that, found some partners. 1 year after closing that duplex, we closed our first syndication deal, which was an 89 unit apartment building.
Damn.
And that kind of snowballed everything from there, right? Continued to syndicate more properties over the next few years, left the job. Fast forward today, we've done like 12 syndication deals, and that's kind of where we're at today.
Yeah. So are you doing this full time?
Correct. Yep.
Oh, awesome, man. What kind of, I'm just curious, like what kind of lifestyle has that like provided you in terms of where you are right now?
It's awesome. I love it. I wake up every day. Of course, there's some things you don't want to do every day, but like most things I wake up to every day, excited to do. The flexibility. I mean, I spent this winter in Miami, was able to kind of live and work remotely for the most part. So I love the lifestyle, right? I still work a ton. I got to work, on weekends sometimes, but like tomorrow afternoon at 2:00, I'm golfing. So it's, I love the flexibility of being an entrepreneur and be able to create your own schedule, but it does have its, there's some stress involved. There's some extra hours you have to work, but overall, I love the lifestyle it provides.
Yeah. Awesome. Yeah. So, winter in Miami, I mean, you're in Wisconsin.
Correct.
All right. I hear the winters are absolutely brutal in Wisconsin.
It sucks. It's good. I love the summers, and the summer hasn't even quite hit here yet. So it's still a little chilly, but it's, the summers in Wisconsin, amazing. Don't love the winters. I'm not gonna lie.
Yeah. I used to work for a sausage maker in Rochester, New York. And
Yep.
we had a ton of orders we sent out to all areas of Wisconsin. And I was like, I asked my boss, Joseph, at the time, I was like, Joseph, why are all these people like buying sausages during the winter? And I was like, and he's like, do you understand like how bad the winters are there? Like they like to eat like really rib sticking type of food and that sort of thing. So
that's funny. It's totally true, man. It's totally true.
So let's rewind the clock a little bit to, duplex to an 89 unit.
Mm-hmm.
I'm like dumbfounded here. So most people think like you got to do, a 2-family and then a 4-family and maybe a 6-family. And then like you have like the universe has given you permission to do 89 unit. How dare you? What was that sort of seminal moment of okay, this is what I'm just kind of like wondering about what the origin of that. And I'm speechless.
For sure. Yeah. I think a lot of people do get hung up there, right? And think there's a sequence of events you have to follow to get before you can do a big deal. And for me, it started with the mindset shift, right? Like you have to be ready to think bigger and be confident you can go bigger. So I subscribe to a lot of Grant Cardone stuff. I love his stuff, 10X brand. I mean, that really a lot of his stuff is kind of what that mental shift helped me out on in the early stages. But once I overcame that, right, and I knew like, hey, I could go big right away. Don't need to go slow. It was just a matter of putting the pieces in place. I think a lot of people look at, if we're talking specific on the syndication model, which is a way to get into these bigger deals, is I need to have all of this experience, right? I need to have $1 million in the bank account to make the bank happy. But that's where partnerships come into play. And that's what I leveraged, right? I didn't have a ton of capital, didn't have experience, didn't have the net worth, but I found a partner that did, right? And I added the value of knowing, a certain piece of the puzzle, and bringing that value to him and that drive, right? And creating that partnership that's led to, being an equal partner in the business and where we're at today.
Yeah. So how did you find this deal? So you made this like mindset shift, right? It's like, I'm going to do something much bigger. I mean, that's more than 10X because 10X would be 20 units, right? So how did you find this deal? Were you like cruising LoopNet, Crexy? Like what were the things leading up to the actual identification of this opportunity?
That first deal was actually through LoopNet. And today we don't really do many deals on market like that, but it was a deal that was kind of in contract a few times, was kind of sent around through LoopNet. And I mean, overall, we actually just sold that property a month or two ago and secured a profit, but overall, a lot of learning lessons on that property, right? I think, a lot of things that we did wrong, right? And that we learned from and now, implemented into future deals. But it was a deal that was on the market on LoopNet through a broker, that we kind of just worked that angle and locked it up that way.
Okay. So, you found LoopNet. I mean, did you underwrite a lot of deals before you found this one?
Yeah. We were underwriting deals for a while. I mean, I think when we first committed to trying to find a deal, it was, a 6-month process of looking at deals, underwriting deals, putting in LOIs. And this was the one that was the right size, right, for us and kind of checked most of the boxes on the deal we wanted to do. So that's kind of what led to us getting in contract.
So how'd this start? You picked up the phone, you called the broker, kind of take me from there.
Yeah, it was, connecting with brokers, which I think is the best way to find deals is good relationships with good brokers. So, it was an accumulation of, reaching out to brokers, setting up meetings, staying on their radar, building relationships with them. And that's kind of how this one came to be. As we were talking to the broker, he had this deal, he sent it to us. In that early stage, right? It's hard to see the premier deal flow from brokers, right? When you don't have the track record and experience of closing, right? Because at the end of the day, the brokers care about getting their commission, right? I have some great broker relationships, but the most important thing is they want the commission, right? So you have to tell them how we're going to close, right? And if you don't have a ton of experience, how do you prove that? Mm-hmm. Leaning on my partner certainly helped, but that was kind of, we had to grind to build that relationship, right? And we kind of saw that deal. It was on market. It wasn't an off market deal, but that's kind of really how that first one went.
Yeah. So you start off with walking the property at first. Did you did you get an offering memorandum and kind of do like a cursory, underwriting of it first? Tell me about that.
Yeah. Underwrote it. And that's really where I started with, when I decided to get into the syndication space, I looked at all the pieces that go into syndication, right? Raising capital, underwriting, asset management, finding the deals. And I decided instead of trying to learn all of this, let me just become really strong in one piece. Mm-hmm. And for me, that was underwriting. So I spent most of my educational hours in there learning how to underwrite, practicing underwriting. So I felt good and confident on underwriting and was always underwriting practice deals, real deals. So when I got that deal, right, I felt good about underwriting and coming to the number that it makes sense at and submitting the offer. So yeah, I saw the deal, got the numbers, underwrote it, put the number out there, got a PSA figured out and kind of, went from there.
Yeah. So what was the asking price on the property?
I believe they were asking like 3.8 and we ended up locking it at like 3.5 around there.
Okay. Okay. So you got a letter of intent accepted. You negotiate the price down a little bit. And then, this is the first time you were, negotiating a purchase and sale agreement or or a PSA. Kind of take me from there. Because I mean, you had this investment partner, which I want to talk about, that investment partner that was
Yep.
like, bring the balance sheet to the table a little bit, but like how, like, did you have a bank already lined up to, finance this deal? How'd you structure it?
Yeah. So PSA negotiations, I mean, having that partner that had a ton of deal experience already. I mean, he already had a portfolio of a couple hundred units and a property management company. Where I was, I did one duplex and it was through a family friend that, it was a pretty straightforward negotiation process.
Mm-hmm.
So having that, really leaned on that through the structure side of the PSA. Sorry, what was the second question again?
Like how did you structure it in terms of like, debt and equity?
Yep.
How'd you find the bank? Like how'd you put this together from a capital stack standpoint?
Yep. So we used a broker, a mortgage broker for the loan.
Mm-hmm.
That was a connection through, my partner was in like a mastermind group and it was a connection to there. So we used him, ultimately ended up using agency debt. So we got a Fannie Mae loan on that.
Mm-hmm.
So that process, learned a lot there. It's kind of a whole other topic of what, learning lessons of dealing with agency debt, but that's the debt we secured, went down that path, right? Figured out what the rate was going to be and actually ended up unfortunately changing at the last minute, which kind of was the first kind of learning lesson on this deal. But, so we had that loan, I think it was 80% LTV. We had to go out and raise like 800 something thousand. So we, each kind of contributed on the capital raising side. Again, that first capital raise was leaning on that more experienced partner to help raise a good portion of the capital. We did a super low investment amount on our first deal, just to kind of bring more people into it and secure that we could close it. So that was, that's kind of what the capital stack looked like on that one.
Yeah. So how many investors did you have involved with, raising that capital for the acquisition?
We had about 25 investors on that deal, which was
Wow.
way too much. I don't regret it because we got the deal done. We got a lot of people involved, but we did a low one. We did like a $10,000 minimum investment amount, which now it's 50.
Uh-huh.
So that was, certainly had a lot of people involved. Luckily, like we had good partners, right? Like wasn't any downsides there, but it was, certainly a lower investment amount than the average syndicator does.
I mean, was that done by design, or was it like, okay, this is the only way we're going to be able to raise the money to take this deal down?
Combination of both. I think it was, the first thought process was, hey, the benefit of it is we can get everyone involved and more people involved, that can, snowball and, will double their money and then they're on the next deal. And, having a wider net kind of puts the brand out there more. So that was the first thought process, which I don't regret. Like I said in the beginning, I don't regret doing it because I think it has led to, rollover investors, referrals. So that was our first thought process. Second thought process was, right, yeah, if we have a lower investment amount, it's going to be easier to raise the capital because we can just stack on a bunch of smaller investors that we already know in our network. So that was kind of the combination thought process of deciding to go lower on that.
Yeah, no, absolutely. I mean, for those of you listening, I mean, just because somebody is willing to put, like, let's say $50,000 into the deal, like, a lot of times people are just testing the waters with you as an operator, and they're not necessarily like, this is like a long-term relationship. My story is like one of my first investment partners that put 50 grand into one of my deals, ended up, putting $1.5 million into one of my deals in the future. Now, that took time of building that track record, but like that, that amount they're willing to participate with my deals in the future, and we still do deals to this day, grows over time. So that's awesome, man.
For sure. Yeah. It's hard to get someone to write that $1.5 million check on the first deal. Right. But by building, showing that you can make them money, right. And then you get to know them more, then it's like, yeah, you work your way up to getting a big check like that.
Absolutely. So how did you structure it in terms of like, was it like a limited partner, general partner standpoint? Was like all 25 investment partners like had a like sort of a pro rata share of the membership interest in it? Like, let's talk about that.
So it was a GP LP arrangement. So it was us three on the GP side and then the LPs. I think structure wise, we, went pretty basic here too. We just did a straight 80-20 split, no preferred return. I think we had an acquisition fee, 2% acquisition fee. Don't even think we did an asset management fee, just straight 80-20 on everything. So it was certainly very favorable terms for the LPs. Right. And I think, in my experience, at least, you can't, nowadays, right, we're doing, 7% preferred return to a 65-35 with acquisition fees, asset management fees, more of the kind of the norm, right, for the syndication.
Yeah.
But, starting out, right, it's hard to command with, again, limited experience, limited track record. You can't kind of go right for that. So our thought was, all right, we'll go lower on that and kind of concede a little bit there.
Yeah, 100%. No, I think that, that's the one thing is that, and people are looking to break into like larger commercial multifamily, or whether it's multifamily or office or whatever, is like, you have to do whatever possible to land that first deal. And then what you did, I think in terms of 80-20% is definitely not sustainable. Cause one thing is, if I'm passively investing in a deal, I want to make sure that the guy who's operating it, like the juice is worth the squeeze for them as well. Because the last thing I want is like that operator to be like, oh man, I'm like getting chump change every month on this deal I put together, and they they end up losing interest on it. So, no, that's definitely great. So, bring it forward a little bit. So you secured the agency debt on it, okay, through a broker, you closed it. And what happened from there? Was it all sunshine and rainbows, or tell me about what happened. What was the plan?
It was not sunshine and rainbows, unfortunately. So it's fun. I kind of be more open about what happened now that we sold it. So we, closed on it. Again, first learning lesson was the debt side, right? Kind of securing more on the front end. We were going into it thinking we're going to have interest only, no interest only, a week before closing. Okay. There's our first kind of downslope. Mm-hmm. So, okay. We could, the returns still look good. We're good. This property was in contract twice before we bought it. Mm-hmm. And we, during due diligence, I guess, didn't fully scope out what sort of tenant base was currently in there. When a property is in contract twice, the whole agency debt, right? The 90 for 90, right? They want to see 90% occupancy for 90 days. Mm-hmm. So the old operator, they didn't really care what kind of tenant was going in there, right? They just had to put bodies in the units and keep the banks happy to keep these deals alive. Mm-hmm. So we essentially inherited a bunch of tenants that weren't even really paying rent. Mm-hmm. So the first year we had to evict 50% of the tenants.
Wow.
We decided, our plan was to go in, put $5,000 into the units, right? Put the LVP flooring in, bump rents $100, $200. That's what we were doing, right? So we did that successfully, evicted those tenants, put the money in, but we weren't expecting to do all of that right in year one. It was more of a, 3-year timeline, but we did it. So kind of blew through all of our CapEx. So we're kind of at zero, right? And then we're like, all right, we're at a point now, it's cash flowing good. We got these rents up, we're, feeling good. COVID hits. 25% of our tenants walked into the office and told our leasing manager, I'm not going to pay rent. You can't do shit about it because you can't evict me. So that was great. So we didn't, 25% of tenants not paying rent for a year and a half doesn't really provide you much cash flow. So went through all of that. And then, ultimately after that's over, we got some money back from, the government programs. They started to feel good again. Then a boiler went out. There's 60 G's. So we're, going through that. And then finally it was like, earlier this year, we were like, hey, this property, we bought it at the right time in the market where we saw some natural appreciation, ultimately found the best buyer we could for this location, sold it to him, for like $800,000 more than we bought it for. So we secured a return for our investors, but yeah, a ton of learning lessons on the operations side. That's for sure.
Yeah, absolutely. So, looking back at it, I don't believe in like regrets or anything like that, but what would you have done differently knowing what you know now?
Yeah. So, first, the biggest learning lesson is, it goes back to location, right? This location was tough. It's a C minus location, and it works for some people. Some people, that's their business model, is they really understand operations, and maybe that's your path. For us, we're no longer trying to operate in those areas. I'm more focused on the A, B areas now, with, that sort of tenant base. So if you're going to go into the C minus areas, you need to be 100% dialed on your operations. You need to have a very good property management. We had a good property management company, but just the asset management, we just didn't really all know what we were getting into on that. And if you're going to go into that space, I think you need to be really good on operating, using conservative expense ratios. You're not going to operate that property at 50%. I don't care if the performance says it's going to be closer to 60%. So, things like that was what was the biggest learning lesson. But yeah, a bunch of smaller things too, right? Just sound like debt, really making sure that they're sticking to the word, right? That the term sheet originally provided, your due diligence, really doing due diligence on the tenant themselves, not just the leases. Like, what does that property look like on a Friday night? What's the word on the street about the property, right? Just like kind of the more personal approach to the due diligence, things like that. I mean, just more CapEx, bring more money into reserves coming in, assume something's going to go wrong because you're holding this property for 5 to 10 years. Something is going to go wrong that you didn't plan for. So throw an extra 50 grand in there for that day when that happens. Things like that. I mean, a lot of learning lessons that we've now applied on our future deals, right? And like those are going great.
Yeah. So, yeah, I mean, I know that, like, for instance, like an 89 unit deal in the $3 million range to me is like, right. I don't even have to know where it is. I'm like, all right, tough location.
Yep.
Cause that one, when you underwrite it, like the numbers are screaming off the page. Like what could possibly go wrong? Especially if you're, one of these investors that have been, sort of studying the Benjamin Grahams, the Warren Buffetts, like, buying stuff at significant discount to replacement cost, buying stuff that has a good margin of safety in it. But I've gotten my lickings through, buying properties that looked amazing on a spreadsheet, but when the rubber hits the road, it's like an absolute disaster. And sometimes like cash flow is a myth. And then fast forward, those properties that are in those challenging locations don't appreciate at the same rate that properties in desirable locations do. So, I'm just curious, like over this time, like, did you have to do any like capital calls from your limited partners on the deal?
Nope. So that was one thing we avoided at all costs, right? We didn't want that on our track record of having to do a capital call. So we actually personally, between us three on the GP side, took out a line of credit in our own name to cover everything. So we took that additional risk as the operators because we knew, hey, we made some mistakes here, right? And instead of having to go to the investors, which I know, there's a lot of syndicators that do capital calls. We didn't want to have that on our track record and have to ask investors for more money. So we took the hit personally, knowing that like our confidence level going forward from here on what we know is that we're going to secure a W on this. So yeah, no capital calls, fortunately.
Oh, that's awesome, man. And that's like a, great part in terms of testimonial to your character. Because yeah, I mean, I've been in that situation where like, okay, do I do a capital call, or do I, take money out of my own pocket because I made the mistake. My investors didn't make the mistake. And this was not like an act of God. This was just like this was just sort of like, foolishness on my part. And, but now going forward in terms of like, how to determine how much capital to raise in the front end. Do you have some buffer on there in terms of like a metric you use in terms of like, okay, I'm going to raise 20% more than what I think I do. Can you tell me about that?
Yeah. So there's, and I really, I've learned that in underwriting, that's one of the biggest things now is forecasting what your CapEx is going to be, right? And what your reserves are going to be. So my approach now, and we're actually more heavily on the industrial side now. So it's a little bit different on CapEx forecasting, but really high level, looking at what is the schedule. Like we have our inspector give us a detailed scope of like over the next 10 years, what could break, what's it roughly going to cost. Right. So we use that. Okay. Maybe there's $50,000 into the roof that needs to go in and this needs to be replaced. And maybe that number comes out to 200 grand. Okay. That's the first line item of CapEx we're going to raise, or reserves we're going to raise. And then on top of that, we'll raise generally, this varies a little bit, but 3 to 6 months of just straight operating expenses. What is the operating expenses on a monthly basis? 3 to 6 months of that. And then usually even sprinkle on another 50K on top of there. So again, not an exact science, but that's kind of the framework we're usually following on reserves, just to have plenty of cash in the account, to weather anything that could go wrong, right? Any vacancy, anything that pops up that was missed. stuff like that. So it's kind of a fine balance, right? Because if you go too high on CapEx, it weighs down your returns to LPs, right? So it's a fine balance for sure of not going overboard, but also remaining conservative.
Absolutely. So we got a few minutes left on the actual interview part of the show. So in wrapping up, what advice do you have, or like, what would you tell like the younger version of yourself in this whole thing in terms of what you know now and what you're focused on now?
I would say learn the money game earlier. I think if I could have understood just how money works, how investment works, how taxes work, how just the general idea of how to create wealth and the easiest way to do it. If I could have started learning that in high school, right, and started reading the books and like listening to the podcasts in high school, I think that would have just fast tracked everything I'm doing now, right? Instead of starting at, 24, 25, I could have been starting at 21 and just been a few years ahead. Because I think that's really the first step, right? Is understanding just how money works, right? Like then you can get into real estate, but like having an understanding of just how wealth is created by studying, whether you study someone or if you just listen to, multiple people, that really kind of opens up the ideas of everything else in entrepreneurship.
Excellent. Brock, thank you so much for letting me pick your brain, so to speak. Hey, if you're listening in right now and you want to get in on the live Q&A with beasts like Brock and our other guests like Stephen Libman and Gino Barbaro and talk to them directly, make sure to sign up for the Go Big Live Facebook group so you can get on the live Q&A sessions that we have with our amazing guests. So for now, signing out. Thanks, Brock.
Thanks, Matt.